Hey everyone, welcome back to the channel. Have you noticed your grocery bill creeping up lately? Or maybe you've winced at the gas station pump. You're not just imagining it. Prices for everything from food to fuel seem to be on the rise, and many experts are pointing to one big idea: the commodities cycle. So, what exactly is a commodities cycle? Think of it as a long-term, decade-plus trend where the prices of raw materials like metals, energy, and agricultural products experience a sustained upswing. This isn't just a short-term spike. We're talking about a fundamental shift driven by massive global demand that outstrips supply. Historically, these cycles are rare. We've only seen a handful over the last century, often tied to major global events like post-war reconstruction or the industrialization of a massive economy, like China in the early 2000s. Today, there's a growing buzz that we might be at the dawn of a new supercycle. Why now? Well, there are a few key drivers. First, we're seeing a massive global push towards decarbonization and green energy. Building solar panels, wind turbines, and electric vehicles requires a colossal amount of commodities like copper, lithium, nickel, and cobalt. The demand for these green metals is skyrocketing, and miners are struggling to keep up. It takes years, sometimes a decade, to get a new mine up and running. This mismatch between soaring demand and sluggish supply is a classic supercycle recipe. Second, there's the post-pandemic recovery. Governments all over the world have been pumping trillions of dollars into their economies to stimulate growth. A lot of this money is going into big infrastructure projects, new roads, bridges, and public transport systems. What do all these projects need? Steel, cement, copper, and a whole lot of energy. This creates another huge wave of demand for basic materials. Third, we have geopolitical factors. Global supply chains have become more fragile and complex. Conflicts, trade disputes, and resource nationalism can disrupt the flow of commodities, making them scarcer and more expensive. When countries start to prioritize securing their own resources, it can lead to a global scramble that pushes prices even higher. And finally, let's not forget about food. A growing global population, coupled with climate change affecting crop yields, is putting pressure on agricultural prices. When you combine all these factors, green energy, transition, infrastructure spending, geopolitical tensions, and food security, you get a powerful cocktail that could fuel a commodities boom for years to come. So, this brings us to the big question on everyone's mind. With a potential supercycle on the horizon, is it time to invest in commodities like gold and oil? Let's break it down, starting with the classic safe haven, gold. Gold has a unique place in the investment world. It's often seen as a hedge against inflation and uncertainty. During times of economic turmoil or when traditional currencies are losing value, investors flock to gold, driving up its price. In a supercycle scenario where inflation is a major concern due to rising raw material costs, gold's appeal can shine even brighter. Think about it. If the cost of everything is going up, the purchasing power of your cash is going down. Gold, as a physical asset with a limited supply, tends to hold its value better in that environment. However, gold doesn't play by the same rules as industrial commodities. Its price isn't driven by demand for building things. It's driven by fear, inflation expectations, and central bank policies. While a supercycle might create an inflationary backdrop that's good for gold, it's not a direct driver. So, if you're considering gold, you're making a bet on continued economic uncertainty and inflation rather than on the supercycle itself. It can be a great way to diversify and protect your portfolio, but it's not a pure play on the industrial boom. Now, let's talk about the black gold. Oil is the lifeblood of the global economy. Its role in a supercycle is a bit more complex. On one hand, a booming global economy means more manufacturing, more transport, all of which consume a massive amount of oil. This increased demand, especially from emerging economies, can definitely push prices up. We've seen this in past cycles. But there's a huge but here. The green energy transition. The whole world is trying to move away from fossil fuels like oil. This long-term structural shift creates a powerful headwind. While oil demand might be strong in the short to medium term, especially as the world recovers and transitions, its long-term future is uncertain. Investing in oil today is a bet that the transition to green energy will be slower and messier than people expect, and that underinvestment in new oil exploration will lead to supply shortages before demand really drops off. It's a tricky balancing act. You have the short-term pull of economic growth versus the long-term push of decarbonization. Some argue this could lead to a final volatile spike for oil prices before a gradual decline, while others believe its demise is being exaggerated. So, how should you approach this? First and foremost, remember that commodities are notoriously volatile. Prices can swing wildly based on news, weather, or political events. This is not a set it and forget it type of investment. It requires active monitoring. If you're interested in getting exposure, you don't have to go out and buy a barrel of oil or a gold bar. There are much easier ways. You can invest in exchange-traded funds or ETFs that track the price of a specific commodity or a basket of them. This is a simple way to get diversified exposure. Another popular strategy is to invest in the companies that produce these commodities. Think mining giants or major oil and gas producers. When commodity prices are high, these companies can become incredibly profitable, and their stock prices often rise. This approach allows you to invest in the underlying businesses, which might pay dividends and have their own growth strategies, giving you another way to win besides just rising commodity prices. But remember the golden rule of investing: do your own research. The idea of a supercycle is a compelling story, but it's not a guarantee. There are risks that a global recession could crush demand. Technological breakthroughs could create cheaper alternatives to key commodities. A faster than expected green transition could leave oil investors holding the bag. Ultimately, whether you should buy gold, oil, or any other commodity depends on your personal financial goals, your risk tolerance, and your own view of the future. The supercycle thesis suggests a long-term tailwind for raw materials, but the path will likely be bumpy. Gold offers a potential hedge against the inflation that a supercycle might bring, while oil represents a bet on the pace of the global economic recovery and energy transition. Consider these as potential pieces of a well-diversified portfolio, not an all-or-nothing bet. Start small, understand what you're investing in, and be prepared for volatility. The world of commodities is fascinating and full of opportunity, but it's also a challenging landscape to navigate. Thanks for watching, everyone. I hope this breakdown was helpful in understanding the commodities supercycle and what it could mean for your investments. If you found this video valuable, please give it a thumbs up, and don't forget to subscribe for more content on finance and investing. Let me know your thoughts in the comments below. Do you think we're in a supercycle? I'd love to hear from you. See you in the next video.